You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. Today, before I begin, I want to remind you, if you have not done so, make sure you go to wealthformula.com. And if you are an accredited investor in particular, sign up for the Wealth Formula Investor Club. This is going to be a year that you're going to want to make sure you get involved, particularly because there's going to be a fair amount of distressed assets that we are going to potentially want to take advantage of. And if you'd like to participate, you want to make sure you get on our list. So go to wealthformula.com. And if you're an accredited investor, you just need to sign up and get onboarded. An accredited investor, by definition, is something that you are or you are not. You don't have to apply for it like an accredited, you like take a test or something. Basically, if you're an individual, it's $200,000 per year for 2 years with a reasonable expectation of continuing that. And if you are a married couple, that number goes up to $300,000. Otherwise, it is a net worth of $1 million outside of your personal residence. If you meet those criteria, you are accredited. So it's like being pregnant or not pregnant. You either are or you aren't. So if you meet those criteria, sign up for Investor Club at wealthformula.com and get onboarded. Now, today, speaking of investing, what's interesting is in the world of investing, the reality is, I'd love to say this was not true, but that you can still do everything right and still lose. I mean, that's just the reality. Frankly, it's supposed to be that way. Otherwise, everyone would make the biggest possible bets all the time and always win, and that's just not reality. In good times, it's very hard to anticipate what could happen if the unexpected occurs, right? You can't really necessarily anticipate the unexpected, and the unexpected always happens. That's the problem. And over the last 24 months, we saw interest rates rise at a slope that's never been seen before in the U.S. economy. And this was literally just a few months after the Federal Reserve called this inflation that it was seeing transient, signaling to the investor world that it was not going to raise rates. And boy, not only did they raise rates, but they raised them at a crazy level. And in part, it's probably because they were slow to react that they did so. In hindsight, all of this, it's pretty clear, right? The subsequent rise in interest rates were significant because they had to curb inflation, which was actually real. It wasn't fake. And it's all clear now, but I don't remember hearing anyone talk about this scenario before it happened. Maybe there were, but I didn't hear anybody talking about that. And as a result, many people lost money, myself included, and continue to hold our breath. I mean, frankly, at rates. Now, fortunately, rates are starting to level out. And as much as we hate it, though, the problem is that, this system that we have of investing and sometimes things not going the way we had planned, this is the way it's supposed to work. And that's just reality. In investing, you have to win more than you lose, right? That's the goal. And so the thing is, all of what we are experiencing right now, it's going to happen again in one shape or another. What I mean by that is, over the next few years, those with, I guess, especially those who are fortunate and have ice in their veins will buy when everyone is scared. And hopefully they'll remember this feeling, though, of what it feels like when everybody's scared, because eventually things will start to feel maybe too good to be true. And as Sir John Templeton put it, at those times, in particular, the most dangerous words for an investor in the English language are, this time it's different, right? I mean, you've seen that in the cryptocurrency world multiple times, right? I talked about how, had I actually remembered that, I would have made millions of dollars from cryptocurrency. But the reality is I've netted out probably pretty much nothing because every time things go way up, I think they're going to keep going up. And then in crypto, it's like fast forward, you push it's like listening to Audible at 10 times speed in terms of regular markets. And so before you have any time to react, boom, it's all over. But at any rate, it would be a lot easier to accept this fact of investor life if it actually applied to the big boys as well, right? To the institutions, but it doesn't. I mean, 2008 was an extreme example of that. The big banks lost big bets, and had those bets come to fruition, certainly they would have made a lot of money, but they didn't win those bets, and unfortunately, they didn't have to pay up. It was the taxpayer who paid for their losses, and all the lawmakers said it would never happen again. But it did. It happened again in 2023. Right? It just happened again. The taxpayer stepped in to bail out multiple regional banks. Now, what's interesting about this is those banks this time, they weren't even being irresponsible. You're going to find out a little bit about that in this interview today. They were investing in a way that would be deemed conservative, right? Yet they too were the victim of ultimately unparalleled rate hikes by the Fed. So the macro economy bit them in the ass like it just did everybody else. And they weren't being irresponsible. They were not being irresponsible, and they were about to lose money and go insolvent and all that stuff. But lucky for them, they were banks and not individuals like us, and they had big depositors from Silicon Valley who were very connected. And what happened with those regional banks is likely to happen again. That's just the way it is. That's the way the system works. It's unfortunate, but it is reality. Now, my guest on Wealth Formula Podcast today is a brilliant professor at Stanford. She's really fun to talk to. She was brought in actually to investigate that regional bank failures, the two of them that happened over in Silicon Valley. And when she has a very interesting take on this. And if you want to have any idea of how, this whole thing in these regional banks worked and how it all played out, you're going to want to listen to this. I found it very fascinating. She also gives her perspective on the health of the banks right now. This is a woman who, is very connected. She's talks to the government, and people listen to her. Jamie Dimon listens to her. So I think it's really valuable information. And when we come back, we will have that interview. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Anat Ahmadi. She is the George G.C. Parker Professor of Finance and Economics at Stanford Graduate School of Business and a senior fellow at Stanford Institute for Economic Policy Research. Her disciplinary interests lie in the interaction of business, law, and policy, and specifically governance and accountability mechanisms in the private sector and in government. She's the author of The Banker's New Clothes: What's Wrong with Banking and What to Do About It. Welcome, Dr. Ahmadi. How are you? Thank you. So let's start with a very basic question. The banking system, what's wrong with it at a high level?
So I am a professor at the business school, and I taught for many years corporate finance. So I come at banking from the sensibilities of somebody who understands, corporate finance and corporate investment and corporate funding and all the stuff corporations do, which is where the investors put their money in their securities. And when you step into banking, you kind of go in the rabbit hole because banks are very abnormal, but not in good ways. Yeah. They're special more in what they get away with is really the bottom line there. And what is it they get away with? That they get away with funding almost everything they do with debt. Part of that debt is deposits. Now, they can forget, in a kind of crazy quote from a bank CEO, they can forget they owe the money just because depositors are so nice to them, walking in and giving them money with no collateral, no covenants, nothing. Yeah. And the depositors are kind of trusting the regulators because on top of the deposits, banks pile up a ton of other debt claims that they use to fund, and almost very, very little, now it depends on the measurements, plain equity, which is where, you invest and you will benefit from the upside, and downside is also yours. Here, because so much of the investment is with borrowed money, you get the leverage effect, which is wonderful on the upside, but kind of wipes you out on the downside. And then the question is, if you can persist living on very little equity and you keep taking the upside and walking away from the downside, or getting the Fed or somebody to help you, then life is good.
Right, right.
On.
So I guess, so why is it important to focus on where banks' money come from?
Because the money that they get, which comes from some of us, obviously, if they put that money to risk, the question is who bears that risk. If they transfer their cost to somebody else and we give them subsidized funding, how are they using it? Are they benefiting the economy? So that's the issue. When you had, I think, laws of easy money, et cetera, it was an issue of, okay, they can do what they want. And then, stuff works well for them on the upside, and can cause big harm to the economy on the downside.
Yeah.
On the downside, it would be like SVB, and we can discuss that. It would be the recent banking crisis, or in the worst case, was the financial crisis. And that caused enormous recession, which we can go into. And that was not because they had too much equity, but because they had way, way too little.
Yeah. So it's a game of heads I win, tails you lose, where the bank is going to win either way. And I think what you brought up was I think is a good example to potentially get into, because I understand that you were part of, or you did some work related to the Silicon Valley Bank. What happened there? I think a lot of people don't really, including me, don't really have a good sense of what happened in the first place to make it insolvent and then ultimately, get bailed out.
All right. I'm so glad you asked it. That's such a great question.
Yeah.
So here's what happened. It's very simple. What happened to Silicon Valley Bank is it had a flood of deposits coming. So during COVID, interest rates were zero, people were getting money, and they oftentimes, just put it in deposits because there wasn't a lot of as many good things to do with them, and it's safe to put it in deposits. Now, Silicon Valley Bank then ended up with a huge amount of deposit money to do stuff with. And it stopped having enough good things to put them in, because when they invest in anything risky, they may have to put a little bit of equity there. So instead, what they did was they put a lot of that money in government bonds, long-term government bonds, which, even though interest rates were zero short-term, long-term could pay you 1.5% or something like that. So
which at the time seemed like a conservative and safe, reasonable thing to do.
So it's safe. So putting money in treasuries is safe from a credit risk perspective. The Treasury will not default, or at least it hasn't so far. And so if you buy a treasury that promises you 1.5%, twice a year, 0.75% for 30 years or whatever, and then you get back your principal, that they'll not default that. The question is, if you want to sell it 5 years down the line and interest rates increased, it's worth a lot less. So on the security that you might buy at par, like, at $1,000 for the interest and then $1,000 back 30 years later, would go down to 900, to 800. So for interest rate increases, the thing loses in value. So
their balance sheet, all of a sudden, their balance sheet shrinks enormously.
Exactly. So all of a sudden, the assets are worth less. Simple.
Yeah.
Just like you can lose on other investment. It just so happened that the long-term investments, when interest rates, however safe they are, when interest rates increase, the opportunities to invest in other things with higher interest rates come about, and something that only promises 1.5% when interest rates are 5% is just going to be worth less. So
mechanically, if I could ask you a question there, when that balance sheet shrinks and all of a sudden they only have a certain amount of equity, what are they? Is there somehow that they get called on the debt? That because they're over a certain limit of fractional lending?
So no. So what happens then is the debt that they have is the same debt. It could be deposits, and then deposits want their money out, which is exactly what started happening. And part of why that happened is because at the same time that the interest rates are lowering the value of their investments in long-term assets, because they're very sensitive to interest rate risk. That's kind of the duration risk to people who know. At the same time, the short-term funding that they have from deposits and others is demanding higher interest rates.
Yes.
So now they either have to pay more or they have them withdraw to go elsewhere to get more.
Right.
And so all of a sudden they gotta, either raise more money or pay down more or pay the depositors to get out or other creditors. They still owe what they owe. And their equities shrunk because their assets shrunk. Just like if your house value went down, you borrowed, with no equity, you'd be underwater. So you're insolvent equals underwater for a corporation. And now they have a situation where their assets are not enough to pay, just like an underwater homeowner. And so what happened then is they first had to sell some of them. So the accounting rules allowed them to pretend to be okay for a while. The depositors were not paying attention for a while. And then what happened is, even though they were insolvent for a few months, as interest rates increased, they didn't recognize that. The regulators were not doing what they were supposed to be doing. And until it came to roost in the sense that they had to sell some securities. And when they sold some of them, they had to recognize the losses on their balance sheet. So all of a sudden, they were booking a loss on the assets instead of pretending that the assets are worth more than what they are. So what you say, the balance sheet shrank, that's in market value. But in book value, they could keep it because they were allowed, if they classify an asset as hold to maturity, they can allow to keep it at original value, at par. And so now they had to recognize the loss because it happened in market. So they had to mark to market their assets. And then it would be the emperor, they're sort of swimming naked, as Warren Buffett likes to say, became more evident. And then in order to kind of plug the hole, they tried to raise equity and they couldn't. And that really exposed their insolvency. At that point, nobody would give them $1 for their equity because they had so much debt and they were insolvent. And that basically exposed their insolvency. Once the insolvency was so clear, and it should have been clear months before, then everybody started running. Then you start talking about panics and runs by all these uninsured depositors on social media or whatever. It's the modern version of standing outside the bank, Mary Poppins, or It's a Wonderful World, the people standing up in line. Now it was through digital. Okay, but it's the same phenomenon. Your bank is insolvent. You want your money out.
Now, of course, then you have the bailout, which defied what the normal FDIC rules were. So maybe you can tell us, what were the FDIC regulations at that point, and then what was actually done?
Okay, so this is again an excellent question. I'm glad you asked these questions because we just go through that. And
I'm going to get an A in your class.
Yeah, good, very good. You're asking good questions. You get an A for that. In the exam, we'll have to ask you about the question. But anyway, so what the FDIC? The FDIC is supposed to insure only $250,000. But the average deposit in SVB, which was all these people around me, I live in Silicon Valley. The average deposit in SVB was $4 million.
Oh, wow. And
there were some depositors who had like $1 billion or more, like four.
Oh, wow.
So they were not insured. So 95, percent of the deposits were uninsured. So now on a Friday, when they decided to close the bank, they said the insured depositors, we created another institution. The insured depositors can get access to their money right away. On Monday, say, it was a Friday, on March 9th or something like that. And March 10th, and they said the uninsured depositors will let you know. Now, of course, everybody here started losing sleep because they were telling them that they don't have access to their money, that they might get only some of their money, they might get a haircut, whatever. So obviously, Silicon Valley is very highly connected. So they start calling everybody and their uncle, all the senators, all the Congress people, all these libertarians right here in Silicon Valley. They all of a sudden didn't want to face any losses. So sure enough, by Sunday, it was declared that SVB was actually systemic. Systemic is the magic word. If you say systemic, then they can bail out.
In other words, the idea and the reason that this was justified is the idea is they could have a significant trickle down effect on the rest of the economy, and that the rest of the country would be in danger, and so almost as a defense.
So that's how they use it. So what does it mean to be systemic? That you're important. So your own failure of default would harm, people. So the people couldn't make payroll or whatever, if you didn't have access to all your money. Or the trickle down, the dominoes, which we describe in the book. And the dominoes are actually, everybody's starting to think, wait a minute, if it's SVB, then it's also this bank and this bank and this bank and this bank. So what happened? First of all, they announced that they will bail out all the depositors on First Republic. First Republic came later. That was a different kind of transaction. SVB, Signature, that was the two banks that weekend. Signature had crypto issues, different things, okay?
Yeah.
And also closed that weekend. Everybody gets paid in full. This was, by the way, I'll go there, not always what FDIC has done over the years in terms of how it handles failed banks. And then, importantly, which the public may have not understood, the lingo there, in the announcement that came on Sunday, March 12th, from the Fed, the Treasury, and the FDIC, they said, okay, FDIC is saying all depositors will get access to their money. Everybody, every single one, 100%. Okay. So even
and
though
where did that money come from?
Good question again. Where did the money come from? They were saying this is not a bailout. This is not going to come from taxpayer. That's how because in Dodd-Frank Act in 2010, Obama said no more bailouts, period. And they were promising no more bailouts. So they hate the word with a passion. They will never admit that they're bailing out. But guess what? They are.
They're bailout.
Because here's what happens. What does a bailout mean? It means that people enter the contract and one of them defaults and somebody swoops in and make it not happen. In other words, the person who took the risk, who imposed risk on another person, whatever, is no longer liable suddenly. Even though they can't pay their debt, the debt gets paid by a third party. So who's the third party here? They're saying, oh, FDIC. Well, how does FDIC get its money? FDIC charges banks. So that's what happened is that FDIC can tax the banking system. So they go to the other banks, especially the big banks, and say, hey, we need money.
Yeah.
And here's what your bill is. And they send them what they call an assessment. So they send, and the big banks, or a group of banks, they grumble and they pay. Now, who is that bank that paid? It's somebody's money.
Yeah.
Somebody in the economy. So it's not coming from Treasury necessarily, but now I'm going to make it a little more complicated. Are you following?
Oh, yeah. Yeah, I'm there. I'm with you.
Good student. The next step, the next little piece of the puzzle is that on the same day, the 12th, when they announced that everybody can go back to sleep, everybody's money is safe, they also announced that the Fed will make loans available, liquidity, they like to call it, to the banks.
To banks, yeah.
And a little hidden fact there were the following two things. First of all, when the Fed is going to open up all kinds of new lending programs to the banks, meaning the bank can come and say, hey, I got that asset. I'll give it to you as a collateral. You give me a loan. They will overvalue the loans. If you come to them with a treasury, usually they will value it at fair market value.
Right.
But they're going to pretend that it's worth at par, what you paid for it.
Okay.
So you can have a house worth $1 million, and that's now worth 800,000, and you get a mortgage lender willing to lend you $1 million.
Yeah. Yeah. And that goes back to effectively, trying to address the initial problem, which was
covering up, kick the can down the road. So the Fed came in to make them a loan, but the Fed is a central bank. The central bank shouldn't make loans to insolvent banks. So how do they do it? How do they cover everything? Treasury makes $25 billion available as backstops to the Fed that they might lose from this overlending to the banks. And now they're saying to the banks, okay, tell your depositors you're fine because you have access to lending from the Fed. Treasury puts taxpayers' money behind this.
Yeah.
Now tell me it's not a bailout.
Yeah, it's a bailout. So the question I guess I have is, we went through this whole process in 2008, and there was all sorts of new laws, a lot of regulations. Were they just, the things that were done, not enough was done to prevent something like this, right? And what should have been done, do you think?
So the book that you mentioned, we wrote
Mm-hmm.
it in 2012-11 after getting into this debate in 2010 and realizing that because there's so much confusion about the topic, that we had to write a book that takes people all the way from a mortgage, all the way to what banks and complicated banks do, and all of that. And by now, it's taking them through what a central bank does and how it all works and how bailouts work and why bailouts persist and all of that. And what we saw is, look, the Dodd-Frank Act, which was sort of the law that was supposed to fix everything,
Yeah.
is a massive piece of legislation, of law. That law, which was like 1,000 pages, had numerous parts to it. It was complicated, but there was Volcker rule and rules about, whistleblowers and rules about, safety and soundness and living wills and on and on and on. A lot of different parts to it. Okay.
Uh-huh.
And I was involved in some of them, particularly, the first and second kind of pillars of it. About how they can fail, and then AIG or Lehman Brothers would go to FDIC instead of to bankruptcy court, so kind of resolution of systemic institutions. They created the Financial Consumer Protection Agency because they saw a lot of fraud. So there are all sorts of things happening in Dodd-Frank. Now, what happened was it delegated to the regulators the fine print rules. And that process just dragged on and on and on and on to the point that the law itself was never fully implemented. And the critical parts of it that were giving regulators any authority they need to make the system safer were just not done properly. And that's the part where I come in to say, I don't like some of these regulations at all. There's just one that I like about equity funding. I'm not even telling you what to do in your investments. I'm only telling you to absorb your losses. Let's start there. Let's correct the upside downside of risk taking. The heads you win, tails you lose. Let's just start there. It's the biggest bargain in regulation. We just got that wrong before the crisis. Let's look how we got it wrong. Let's look how it was designed, which I'm not even getting into all the details of that and the risk weights and this and that. And let's just do that better. And we were saying this with a bunch of academics back in 2010, and they just wouldn't listen. And there was just so much nonsense in this that the book is called The Banker's New Clothes because it's sort of naked emperors. It's like debunking flawed claims. So we went to explain, and we explained again, and we argued again. And, it was really a sobering experience for me because I don't want to hear it. So bottom line is that they didn't fix it, even despite what they say.
Yeah.
The regulation remains in one or two words, a mess. A mess. Too much, too complicated, just like the tax code. The tax code is a mess.
Yeah.
You may teach your listeners how to take advantage of that, but that's what everybody tries to do about every rule. I have a cartoon that I show my students saying, these new rules will completely change the way we get around them. Of course, everybody wants to get around the rules. But, you want the good rules and then let people play by the rules. That's supposed to be capitalism. You know what I mean?
Yes.
In banking, they're bad rules. And then there is just a lot of privilege. And it's just a toxic mix of kind of nonsense and politics and all kinds of things.
I have sort of one final question for you is this, is that, what you talked about with the example of Silicon Valley Bank, again, when you look at it on the surface, it doesn't look like an example of greed. It seems to me that what they were trying to do was effectively, put their money somewhere that was safe and secure and quote unquote conservative. And so when I think about what happened with them, how is this not happening across the country to every regional bank out there? And will it, I guess, is the better question.
It is. So there was a study right around that time that SVB came out showing that, and this goes back to FDIC saying in December. So this thing happened in March. In December, the FDIC published a report that I believe put the unrealized losses, meaning losses that happened but are not recognized on balance sheet on disclosures, at, I don't remember now what the figure was, but it was hundreds of billions. A colleague of mine did a study examining the sort of mark-to-market losses of in the banking system as a whole, and it was over $2 trillion of unrealized losses. So this is happening. And this was just the ones from increased interest rates. Now, they could go and hedge that. So there are all kinds of hedging instruments. And what further research showed was precisely this, what's called gambling for resurrection, meaning when you're really close to default, you'll just double down on risk. So they did not, the weakest banks did not hedge. And so but now we're supporting them. So we're kicking the can down the road the way we did if you have older listeners, the savings and loan. They were in the 80s, high interest rates and really weak savings and loan. And we just let them persist and loot and do all kinds of things. And then we had a major crisis in our hands. So another thing that's happening right now, again, for just the overall big picture, commercial real estate.
Exactly, because I was going to say that the majority of those lending in commercial real estate is at the regional bank level.
Exactly, and so
it's a
commercial real
mess.
estates are huge. So here's my point. My point is, yes, things seem. I mean, what did First Republic do? So that was the kind of the thing that happened in May 1st. First Republic ended up being sold to J.P. Morgan Chase. And that was another insolvency. What was the business model of both SVB, and they're right in the area here. They were touting rich depositors, venture capital firms. They would make them loans. They will help them out. They will throw parties for them, here. And First Republic was making loans to rich people, long-term interest rate only, to buy mansions. Now, there wasn't a default risk, but once again, they're getting paid 2% a year and they have to pay 5%. Well, that's a formula for disaster. So the question is, when the losses come, do you have enough equity? That's all.
Yeah.
Well, and the answer was they didn't. So the regulation put it that depositors are passive creditors. So they didn't have a debt covenant to say, hey, wait a minute, if you're taking risk, even interest rate risk, you should have some buffer of equity to absorb it. Otherwise, the risk will fall on me. Instead, they call the FDIC to bail them out.
Yeah. Now, so interest rates obviously have come down a little bit. And does that, I mean, from your you're not forecasting per se, but from what you know, are we getting to a place that there, maybe not as much risk out there, or is it still pretty?
No, I think the commercial real estate, if you saw, there was actually just a story about it in 60 Minutes last Sunday. The commercial real estate problem is partly COVID related.
Yeah.
And it's partly office space and big cities. And so the value, there's a lot of supply of office buildings in large cities. It's very hard to convert that to other uses. And so there were a lot of bad loans. I mean, right here in this area, and with robberies and whatever else,
San Francisco.
Walking,
it's
exactly.
a ghost
People
town,
are walking
right?
up shopping centers and just leaving them.
Yep.
So there's a lot of defaults on a lot of loans that were for various commercial space, office space, shopping center space, other things. And it's partly sort of online economy and COVID economy, a hybrid workplace, all kinds of other processes that are making the real estate market kind of play out that way. So there is still a concern. And in fact, what you hear is the term extend and pretend. And that is, again, hiding losses they just try to, so that's kind of the symptom of insolvency for corporation, is they sort of try to not admit that you're insolvent. So there's just always that game in general. Try to live another day and hope for the best, gamble, whatever, to get back in life. So that's happening to various institutions in the system. So there's still concerns of fragilities. Basically, we kept a fragile system going. And then when suddenly it shows how fragile it is, we're like, oh, oops, what just happened?
Yeah, and at the end of the day, it's hard to change behavior when the banks are looking at this and saying, well, we'll get bailed out.
I lobby. That's what they're saying right now. Right now, I mean, the debates are unbelievable. They're putting ads all over the place about some tweak in some risk weight. I mean, it's all in the weeds. But the bottom line is, there's just so much nonsense they get away with, and so much recklessness they get away with, and somehow they're telling us it's all for us. So there's just a lot of misleading claims in the space of banking. And that's part of the problem, is people are not really understanding why the system, it looks fine. You know what I mean?
Yeah.
It looks fine and sounds fine if you don't know what they're saying.
Yeah.
But really, when you look closer, like me, it's not pretty. It's not okay. It shouldn't be okay.
So the book is called The Banker's New Clothes: What's Wrong with Banking and What to Do About It.
Just
The
tell them
new
how big
clothes
a
is,
bargain this is. The book is under $20 for 624 pages.
and it's available everywhere. I'm assuming Amazon and all the usual outlets. Um, is that The Banker's New Clothes? Is that referring to the emperor has no clothes?
Yes, that's what it's about. And the banking emperors are coming from many places, including academia. I mean,
Yeah.
there are just many enablers. It takes a village to maintain all
Yeah.
this facade of everything's fine and they're special this way or that way. So I just submitted to the regulators a comment letter, and I was fuming as I was writing it just last week about the same debate. And we revised the document that's kind of attached to the book, called The Parade of Banker's New Clothes Continues, because the emperor's new clothes, when the little kid says, hey, the emperor is naked, he doesn't feel like admitting it, so he keeps marching down. So we debunk, and they keep saying it. It's the most frustrating thing. And so now we have a collection of 44 flawed claims, and we debunk them one by one. Variations on a theme. Oh, this, oh, this, oh, this. They have a whole collection of them. And they'll bring them out to lobby, depending on who the audience is. They'll say, oh, competitiveness, the Europeans are not, any kind of excuse all the time. So
Yeah.
it's real rabbit hole that way. And, it seems to be depressingly, never fixed because there's too much politics in banking.
Yeah.
That's
Fascinating conversation. And thank you so much for joining us. Anat Admati. The book again is The Banker's New Clothes: What's Wrong with Banking and What to Do About It. Thank you so much for joining us on Wealth Formula
Thank
Podcast.
you.
We'll be
You
right
get an
back.
A for your good questions.
Welcome back to the show, everyone. Hope you enjoyed it. Fascinating story, in my opinion, what happened there in Silicon Valley with those banks. And again, it just goes to show it's just, it's not a fair system. And but don't hold your breath. I don't think that system's changing anytime soon. It's going to, it's just a power thing, right? At the end of the day, they have power, we don't have power, and that's the way the world works. So do the best we can, and you can still do well in the long term. That said, I again do encourage you to sign up for our accredited investor list if you've not done so at wealthformula.com, and start to participate in some of these things, and hopefully take advantage of this new cycle, I think, that is about to start in the real estate space. And we have lots of other things going on outside of real estate, specifically in things like aviation. We have an ATM fund, that kind of thing. And we're going to have a lot more interesting things, including mergers and acquisitions and that type of thing as well. So that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.